Hi, my name is Amber Robinson, and today we'll be discussing the One Big Beautiful Bill Act, acronym OBBBA, and the business entity choice, the tax implications for each type of entity from 2025 to 2026 and beyond. So, we're going to be discussing the major changes under the OBBBA, how those changes affect each business entity, and why the law shifts the historical advantages among pass-throughs and C corporations. We'll cover the permanent 20% deduction for qualified business income, the expanded rules for qualified small business stock, improvements in depreciation and interest deduction rules, and the limits imposed through the excess business loss rule. The One Big Beautiful Bill Act became a law on July 4, 2025, and it brings major structural tax updates. The qualified business income deduction becomes permanent. The rules for qualified small business stock expand significantly, and the definition of adjustable taxable income from business interest deductions reverts to an earnings before interest tax depreciation and amortization model, allowing companies to be able to expand more on depreciation costs. The IRS has already begun releasing guidance explaining how these rules apply beginning in the 2025 tax year. The excess business loss limitation also becomes permanent. For 2025, the IRS sets this limit at $261,000 for a single filer and $522,000 for joint filers. Any loss above that amount must be carried forward as a net operating loss, and collectively these changes influence how owners evaluate risk, investment, and long-term structure. Entity choice determines whether a business is taxed once or twice, how losses are deducted, how much income stays in the business, and how investors will view future growth. The Act changes deductions, limits, and reinvestment incentives, meaning the best structure for a business in 2023 may not be the best structure moving forward. So, pass-through entities benefit most from the permanent 20% deduction for qualified business income, which lowers the effective tax rate for many owners. These entities also are affected by the permanent excess business loss limitation, which restricts how much loss can offset other income in a single year. For 2025, the maximum deductible loss is $261,000 for single filers and $522,000 for joint filers. This also reflects the importance of state and local tax rules, which the acronym is SALT, and the individual SALT deduction is still capped. However, many states allow pass-through entity tax elections, letting the business pay state taxes at the entity level. So entity level state taxes are not capped, allowing owners to bypass this individual SALT limit and claim a full deduction. So I know we haven't gone through that in class, but nevertheless, this bill creates that opportunity. C corporations maintain the 21% corporate tax rate, giving steady planning opportunities. Major benefits come from the expanded qualified small business stock rules, which now allow partial exclusion after 3 and 4 years and full exclusion after 5 years, along with higher gains limits and increased eligibility thresholds. This benefit is for founders and investors preparing for future sales. C corporations also benefit from improved interest deduction rules and increased depreciation advantages. Section 179 that we talked about in class allows over $1 million in immediate expensing for qualifying equipment with phase-outs beginning above $3 million in property placed in service. Also, bonus depreciation remains at 60% for 2025, but this also provides any incentive for reinvestment. So, Pass-Through Pro offers strong advantages such as single taxation and the permanent qualified business income deductions. Owners who rely on annual distributions often find the structure the most tax efficient because income is taxed once and is reduced by the 20% deduction where eligible. Pass-through entity tax elections also help bypass SALT deduction cap, which is especially beneficial in high tax states. However, the limits on excess business losses and income thresholds for service-based businesses can reduce the benefits. High-earning professionals may have reduced access to the deduction depending on income and the type of service they provide. These factors mean pass-through structures remain strong but are more complex to evaluate under the One Big Beautiful Bill Act. C corporations, they really do shine when companies reinvest profits or plan for a major exit event. The stable 21% rate, expanded qualified small business stock exclusion, and improved depreciation rules all make the structure attractive for high growth businesses. Investors often prefer C corporations because of the chance to eliminate tax on stock sales through Section 1202. Now, the disadvantages remain centered on the double taxation that we talked about in class. Now, those profits, when they're distributed, they are taxed both at the corporate level and again at the owner's return. So this makes C corporations less appealing for owners who depend heavily on regular distributions. So planning must weigh these factors carefully. For a business expecting to scale quickly and sell within 5 to 8 years, a C corporation structure is often the most tax efficient. Under the Act, the qualified small business stocks rules allow partial exclusion after 3 to 4 years and a full exclusion after 5 years. This means that if an owner sells their stock after meeting the requirements, most or all of the gain could be completely excluded from tax. This example highlights why investors and founders of technology firms, manufacturing companies, or startups may prefer a C corporation. The combination of reinvested profits taxed at a lower corporate rate and potential tax-free exit makes the structure ideal for businesses focused on long-term value rather than annual profit withdrawals. So if a business owner takes income every year, a pass-through structure generally provides the best after-tax outcome. The owner pays tax once, and a permanent qualified business income deduction reduces taxable income. So, for example, if an owner earns $150,000 in qualified income, the deduction may reduce $30,000 from their taxable amount. Now, avoiding double taxation is especially important for the service businesses and small operations where owners depend on ongoing cash flows. Pass-through remains the most efficient structure for these situations because they allow profits to be taxed once and reduce taxable income through the deduction in potential state-level pass-through entity elections. Now, despite the benefits under the One Big Beautiful Bill Act, several risks remain. Converting from a C corporation to an S corporation can trigger a built-in gains tax for 5 years if the company has appreciated assets. This can create unexpected costs if the company plans to sell assets shortly after conversion. Businesses must understand that these transition rules are there so that they can avoid unnecessary tax. Additionally, maintaining eligibility for qualified small business tax stock is complex. If a business exceeds asset thresholds or engages in prohibited activities, it may lose the benefit entirely. State tax rules also vary as well. Some state taxes do not conform to federal qualified small business stock rules, meaning gain is excluded federally may still be taxable at the state level. These details make planning essential. The One Big Beautiful Bill shifts tax incentives across entity types. Pass-through benefits from the permanent qualified business income deductions and strategic state-level elections. C corporations gain powerful long-term incentives through the expanded qualified small business stock rules. Choosing the right structure depends on whether profits will be withdrawn early, reinvested, or used to position the business for sale. Owners should not treat entity choice as permanent. As the business grows, adds partners or changes strategy, the structure may need to be updated. Regular review of tax professionals ensure that the business remains aligned with the saving opportunities created under the One Big Beautiful Bill Act. So it's always good to reassess the structure from time to time. So sole proprietors benefit from the permanent qualified business income deduction, which can reduce taxable income by up to 20% for eligible owners. However, they are fully subject to the excess business loss limitation, which caps deductible losses at the IRS threshold for 2025, $261,000 for single filers and $522,000 for joint filers. Loss above the limit must be carried forward. Also, sole proprietors also benefit from the updated adjustable taxable income definition that we talked about earlier. This allows more interest to be deducted for leveraging businesses. These rules help sole proprietors manage capital-intensive operations but limit those relying heavily on loss deductions. C corporations maintain a predictable 21% federal tax rate, which supports reinvestment and long-term planning. The expanded rules for the qualified small business stock are also most significant, like we said before. And also, again, C corporations also benefit from Section 179 expensing, higher thresholds for immediate equipment deduction, and more advantageous interest deduction rules. These features make C corporations well suited for high growth environments or business seeking investments from outside capital. S corporation shareholders continue to receive the permanent qualified business income deduction, but they must meet wage and basis requirements to claim it. S corporations are also subject to the excess business loss limitation at the shareholder level, meaning losses that exceed IRS limits must be carried forward. The business and interest limitations applies both at the entity level and owner level, meaning any disallowed interest is passed through. S corporations also benefit from pass-through entity tax elections in states that offer them, which can also help bypass the state and local tax cap for owners. Partnerships and limited liability partnerships offer flexibility and generally allow losses and income to flow directly to partners. Under the One Big Beautiful Bill Act, the partners face excess business loss limit at the individual level, and any excess flows into future years. Partnerships also apply the business interest limitation in the first at the partnership level, and then again at the partner level if interest is disallowed. Partnership benefit from improved depreciation and expensing rules, which can significantly reduce taxable income for businesses that invest heavily in equipment or technology. However, increased reporting requirements under the Act can add administrative challenges, particularly for service-based firms. Many provisions under the One Big Beautiful Bill Act apply across entity types. For example, the improved business interest rules apply to both corporations and pass through, allowing more interest to be deducted due to the earnings before interest tax depreciation and amortization standard. Bonus depreciation improvements also affect all entities investing in qualifying assets. The permanent excess business loss limitation affects all non-corporate taxpayers, meaning sole proprietors, S corporations, and all partners face the same IRS thresholds on deductible losses. These overlapping rules create common planning considerations across different business structures. This table visually summarizes how each entity type is affected by the One Big Beautiful Bill Act. For example, sole proprietors and S corporations benefit from the 20% qualified business income deduction, but face restrictions through excess business loss limitations. So, I wanted to reflect on how the One Big Beautiful Bill Act demonstrates the connection between tax law and business strategy. The law really shows how Congress uses deductions, exclusions, and limitations to influence business behavior, encouraging investment and controlling loss usage. Understanding these patterns is key for accountants and business owners when making decisions about structuring their operations. Learning the excess business loss limit, qualified small business stock rules, and qualified business income deduction, and how they operate together provide insight as to why entity choice is now more complex. This lesson helped me prepare to become a professional where I may potentially advise businesses on how to structure their business as well as, understanding their taxation limitations and how critical that is. Again, the One Big Beautiful Bill Act changes create a clear situation across the board for all entities, although complex. And it does create clear winners and trade-offs across business types. Pass-through owners benefit from stable deductions but face stricter loss limits. C corporations become more appealing for long-term growth and exit strategies due to expanded qualified small business stock exclusions. Interest and depreciation improves support businesses that invest heavily in capital assets. So the key takeaway here is that the entity selection now depends heavily on distribution behavior, reinvestment plans, and long-term goals. You should really consider revisiting the structure of your organization regularly, and this will ensure that the business remains aligned with the most advantageous provisions under the One Big Beautiful Bill Act. Again, choosing the right structure for the One Big Beautiful Bill Act involves comparing tax results based on business goals. Owners who plan to sell the business or raise outside capital may benefit from a C corporation because of the potential tax-free gain under the qualified small business stock rules. Owners who withdraw profits annually often remain better off using pass-through structures due to single taxation and qualified business income deduction. Because the One Big Beautiful Bill Act rules vary across federal and state systems, and because certain provisions may shift over time, the best structure can change as well as business grows. So business owners should perform periodic structure reviews again to ensure that they continue operating under the most tax-efficient model. So the final slide lists the sources used to complete and compile this presentation. The IRS is the primary authority for interpreting and applying tax law, and all One Big Beautiful Bill related thresholds, limits, and rules reference current IRS publications. Additional commentary from tax advisory groups provide context for how the law influences practical business decisions. This concludes my presentation. Thank you so much for your time.